Good afternoon, everybody. We are about to get started. We're going to kick off after lunch with a session about private company data, which, as we all know, is always a challenge. And I'm going to hand it over to Russell Perkins to introduce the panel and what you'll be talking about. Russell.
Thanks, Kathy. This session really is meant to take a look at what's involved in collecting private company data. And we're talking again about really small, medium-sized businesses as opposed to larger companies, although there's a lot of interesting things going on in the larger company space as well. What we're really getting at is what is the complexity of going after this data? Why is there this seemingly superheated demand around it? The number of new entrants into this space is kind of incredible. How do you find a niche in the marketplace, whether you can work or need to work with partners? We want to just sort of range over all the issues that go into building these very complex specialized databases. The other thing that I did want to point out is I'm using the term private company data sort of in its broadest sense, and I'm including the personnel that are associated with that, with companies as well. So we're going to be looking at the whole picture. We've got a great panel today, and I think this kind of gives us a whole different sense, a lot of different perspectives of the marketplace. We've got Sam Hamadeh from Privco, which is a startup of its own and doing some interesting things in the space. We've got Jimmy Becker from NetProspects, who comes at it from a whole nother angle. And we've got Eric Arani from S&P Capital IQ, a company that I think you all know that's just recently made a very big push into expanding its private company database. So three very different types of companies, I think three very different perspectives on the marketplace. And because of that, I thought we'd kick off and just have everyone do a very brief introduction and overview so you can get some context around each company, which I think will help the conversation. So Sam, would you like to kick it off?
Sure. Are we doing the slides or just?
Yeah, I thought we'd just do the slides.
Sure.
It's a clicker on there. Sorry.
Absolutely. All right, I'm Sam Hamadeh, founder and CEO of Privco, here from New York City. So we call this the Private Company Financial Data Authority. Our motto is Private Company Financial Intelligence. So as Russell said, we're not just attacking private company data, but we're doing it for a very specific user base, the financial professional. So it's not really meant for sales leads, it's not meant for prospecting, it's not meant for sort of broad research. It has to be very precise because the financial user, the banker, the corporate attorney, the private equity firm, the venture capital firm, they really need precision. Whoops, forward. So I mean, the size of the market, I think you all know, it's an enormous market. It's obviously not as big as the market for stock financial data, but it's still quite large as far as the importance of these companies. That in the U.S., for example, 150,000 companies have over 10 million in annual revenue, and 90% of those are private. Now, as you get to the very top of that pyramid, you start to see, disproportionate number of them are public. But more than you would imagine. By the time you get to sort of that 80th percentile in size, almost 80% of those very large corporations are actually private companies. It just gives you kind of a collage to give you a sense of just how important private company universe is. It includes really industry leaders, anything from Chanel, Armani in fashion, IKEA in furnishings, hotels, you have Hilton, Four Seasons. Food is dominated, frankly, by private companies. The largest restaurant chain in the world, Subway, is private. Boston Market, Cinnabon, all are private. It's diverse as Gibson guitars, Bose speakers, Lego toys. So it's an enormous part of corporate America and actually global corporate sector leaders as well. So when we say financial professional, just to give you some examples, like 3 uses of Privco data, and why I don't get enough sleep is because the level of precision the financial user demands are not estimates, they're not ranges, they really need precise confirmed figures. And so unlike maybe some of the peers, Privco does not use estimates, we do not use ranges, we don't model revenues, we need the actual financials. And they must be accurate literally to the dollar. Otherwise, we retain a questionable figure, but we will not publish that. So it does make our life very difficult because we set a high standard for ourselves. And again, it's because we're not focused on a salesperson where knowing, for example, IKEA might have between, just knowing it's over $1 billion is probably enough for a salesperson. For a financial professional, looking at possibly selling a company to them, they also want to know what deal activity they've had. They would want to know what the ownership structure looks like. They would want revenues for, let's say it's a management consulting firm doing market segmentation, that type of level of research and market share. They need to know the precise revenues of IKEA, not just 2 to 10 billion or 2 to 5 billion or even 2 to 3 billion. They need to know it's precisely, what that figure is. And even they would want to know the historical growth rate, for example. Are they gaining share, they're losing share? So we've set a very high bar for ourselves, but again, we're really going after the financial professional that would otherwise, for stocks, use a Bloomberg terminal or a Capital IQ, something very advanced, not someone who would probably just pull a D&B or a Hoover's or something like that, or even for a sales prospecting database where ranges are acceptable. For us, ranges, estimates are verboten. So Proofco does finally solve this problem. We do cover over 230,000 major private companies. Again, we're not trying to cover every private company that exists. You'll never see us throw out a figure that says we have 8 million private companies. We only have the private companies that matter. And then of that, of course, a slice, maybe a third, where we can get confirmed, verifiable financials. How do we get it? People always ask. Obviously, I'm not going to just give you a whole lesson here. But my background, I think, gives you an idea of just the type of skills required. I guess does not include that slide, but a little bit. But it actually comes from over 2 decades of literally just almost being groomed to create and run Proofco. I am a licensed corporate attorney. I've worked on IPOs, venture capital deals, mergers and acquisitions, private equity transactions. I've been the entrepreneur. I founded Vault.com, another data provider. That one is on job search and careers and employers. Ran that for over 11 years before selling a majority of that to a large private equity firm in 2007 before founding Proofco. And I also have an MBA in finance from the Wharton School. So really, this is sort of my home away from home is Philadelphia. JD from the University of Pennsylvania Law School. Having raised venture capital myself, so I've been the entrepreneur on the other side, negotiating those term sheets. I've been the lawyer on that side of the table. I went through an M&A process for a boutique M&A process with a boutique investment bank selling a private company, either to another private company, a private equity firm, or a public stock buyer. We got bids from all those categories. So really have learned it from every possible angle. And the people we have on board are highly skilled, forensic accountants, corporate attorneys, some of them are investigative business journalists. And that combined with a 20-year network, calling in lots of favors from contacts at VC firms and investment banks, working on deals. It's a lot of elbow grease. So we did not do this because it is easy. To paraphrase JFK, we're doing it because it's hard. But no, what we've taken on is incredibly difficult. And the user often has a sample size. The first thing they do when we do a demo or meet with them or give them a trial is a private equity firm looks up the companies they own. It's the first thing they do. Doesn't matter where you want to take the conversation. They just want to go immediately. It's 90% of the time. They always start calling out companies they own. They have the financials in their hand. So the notion of like a cockroach effect, if you fail in those first 4 or 5 where they know the numbers, they don't need to look any further. You can't even have one of those be wrong. So it's a very tough challenge. It'll probably take us 20 more years to get it right. So we'll see you at the next 19 conference.
Thanks. Jimmy?
Hello, everyone. I'm going to give you a brief overview of Net Prospects. I lead the content strategy and team there. I think the contrast with Sam's company is going to be very good because we are in the sales and marketing space, and the precision we seek is very, very different than what he just spoke about. So very briefly, so who are we? How did we start? So we've been around since about 2007. We're up to about 100 employees now, and we primarily have a database of B2B contacts, about 40 million of those we have, more or less. You could think of us, I think this is probably fair, we started out as a fast follower of Jigsaw, for those of you familiar with them. And I think the distinction with us is our founder thought the crowdsourced model was a very good model, but what it was lacking was a a quality overlay, because you can get a lot of quantity with the crowdsourced model, but it's a little bit suspect with quality. So what we've done is introduce a quality overlay to the crowdsourced model, and we've since evolved over time, and I'll talk more about that in a moment. Today, you could think of us as roughly we provide 4 services to B2B marketers. We can take their data, we can assess it, figure out if it's good or bad, what's right and wrong about it. We can cleanse the data that's wrong and fix some of it. We can also enhance the data they have. We can append and enrich it with new data. And then lastly, we can do what we've always done, which is add net new data that they don't have, that we have of our own. So very, very briefly, you can think of that's the frame for us. So as I said, we've evolved on, we're not just a crowdsourcing model anymore. We multi-source our data. The crowdsourcing is nice and important, but we add on to that in a couple of important ways. The first is we partner with industry players of various sorts to license their data and add it on. It's a nice complement to the crowdsourced model. We probably have about 36 of those, some of whom might be in the room now and you're probably familiar with. And then the third thing we do is, one of the nice things about our model is we know exactly which contacts our customers like and use because they download them and we see them, and so we know which ones are most important, the type of records they're going after. So we've now started directly researching our own contacts, and we go out and get more of the ones that we think are valuable. So you could think of the crowdsourced model as a very random approach. You get what you get, and the direct research as a very non-random approach. We're very focused on the ones that we want to have. But as I said, quality is a real issue in this space, and so what we've done is, and I'll talk more about this in a moment, we've applied this quality layer to what we do, and as you can see in the numbers there, it has a dramatically big effect. Roughly speaking, we've probably processed about 400 million contact records inbound since we started. That's a lot of records, obviously. But only, a little more than 10% of those records are good enough to make it into the database of the ones we sell. So there's a lot going on behind the scenes to process those records and weed out the bad and keep the good. It's a pretty remarkable ratio. We like to say we're pretty picky and choosy about the records that we'll accept. So what is the quality process? Very briefly, we market it as CleanStep, and you could think of that as our process IP. That's really the secret sauce. It's the quality stack that we have. And the way things work, we always start with a basic business card of information that comes in various ways. Name, title, company affiliation, postal, email, phone. That's what we start with. So the question is that a good record? Is that something that we can sell to customers they're going to be happy about? So the first part of our quality process is we just filter out the obviously bad ones. There's nothing terribly special here. In our world, we don't sell incomplete records. If it's lacking any field, we won't sell it. We don't participate in the consumer space, so we throw away all those emails. Generic emails are things like webmaster ad and sales ad. The people to whom we sell don't want those, so we throw all those away. So there's a variety of inbound filters that we apply that filter out a lot of the records right away. And then the second step is what we like to think of as our three-dimensional verification model. And this is where we really apply a lot of knowledge to figure out what's good, what's bad, what might have been good last month but is not good anymore. And it's a combination of email, phone, and social. So what we do is we will email verify every one of our records. Our customers don't want to send hard bounce emails, obviously. And we make, this is a pretty remarkable number for a small company like us, we make about 1 million phone calls a month. So we are checking a lot of phone numbers. And if you can't get through to the person, that record is tossed. So about 1 million phone calls we make to verify whether the phone number is good. And then the third is we try and apply a match to a social profile, because You could think of this statistically. The likelihood the record is good is much higher when you triangulate across these three things. Is the email good? Is the phone good? Is there a LinkedIn match, et cetera? So in brief, that's clean step. That's the quality process IP layer that we apply to everything that we do and really makes us different than others that are doing something like this. So really just to wrap up, so where are we today? So we've moved beyond just selling lists of contacts, and our customers like the story that I just told you very, very fast. They like these things that we apply to our data to ensure that the quality is good, because our customers, B2B marketers for the most part, they have these marketing databases that are really trouble. They've acquired them various ways. They come home from trade shows. They've merged with other companies. Their sales guys are loading into Salesforce, and we all know what happens when you do that. And they have these marketing databases that make them nervous. And so they said, we like your story. Can you do the same thing to our data that you do to your own data? And like anybody would say, the answer is sure. So we've essentially built a suite of cloud-based services that take the process IP that we've created and offer it to customers to do their own data. And that's what I started out by saying. So we can take your data, and we'll do this for free, actually. You can send us your data. We'll assess the whole thing. We'll tell you if the phone numbers are good or bad, if the emails are good or bad. We can categorize your job titles, et cetera, so you'll know if you're marketing to the people you think you're marketing to. You may think you're marketing to finance people, but it turns out everyone in your database are HR and you didn't even know. So we'll assess your data. We'll cleanse it. We'll tell you which records are good and bad and which phone numbers are good or bad and the emails that you need to worry about because they might be spam, et cetera. We can enrich your data, as I said, by appending additional information that you're lacking because you don't have those fields filled in. And then lastly, we can do what we've always done, which we started at doing, which is we can grow your database with net new records that we have that you don't have. And we're happy to sell those to you to enhance and enrich what you have. So very briefly, that's where we are today. We started out collecting contacts. We still do that, and we've moved on to continue to do that, but have a complete suite of cloud-based services.
Eric.
Hello, my name is Eric Arani. I'm on the content and analytics team, and I specialize in financials for S&P Capital IQ. And I'd like to just give a brief overview of S&P Capital IQ and then kind of briefly discuss some of the challenges that we've noticed and focused or have experienced working with private company financials. S&P Capital IQ, we offer the highest quality financial information across a global universe of companies, and it's accessible through various different formats. We have a web-based product that you can access from your desktop. We have a screening tool, so you can screen on various financial data points. You can pull in our financial data through Excel, and we also offer our financial data through feeds. Most of our clients, they're clients that are digging into and doing deep company analysis, and it includes investment banks, investment managers, private equity firms, and they're closely analyzing this both public and private company financials. We collect thousands of financial data points across hundreds of thousands of documents, and we're basically a global universe, and we cover 99% of the global market cap for public company financials. So in addition to the public company financials, we've seen a very high demand from our clients that want private company financials in addition to the public company financials that we source ourselves. And they expect the same quality of data that we're currently collecting for public companies. So just a brief overview of the challenges that we've seen. Sam hit on this first point, just the sheer number of companies. I mean, he mentioned the US, where 90% of the companies are private with revenue over 10 million. When you expand that globally, it's exponential for the number of companies that you're covering. So that creates a new challenge in terms of either collecting the data yourself or partnering with other companies and receiving the data and then standardizing yourself. With private company financials, you know, the quality of the data is often questionable. They're not regulated as heavily as public companies, so they themselves can report errors when they report financials, and then the underlying source is not necessarily available, so it's very difficult to verify what financials you're actually looking at. The level of detail is limited, and it's definitely inconsistent across the regions of where you're looking. You know, in the US, you may get a few data points, but then if you go to the UK for private companies, you may get a lot more detail. So it varies based on region and you know, the company itself. The timeliness is another question. You know, all of our clients are expecting the latest financials as soon as possible. So if we don't have the latest annual financials available, they'll want to know why. But these private companies they're not regulated as much, so they don't have to file as frequently as public companies. And then we have unique challenges ourselves as, you know, S&P Cap IQ. We provide all of our financials in a standardized format. So, you know, our income statement is in a standardized format, so you can analyze companies on an apples-to-apples basis, regardless of whether or not it's a public company or a private company. But that brings in other challenges based on the source of the financials that you're getting in the private company and the level of detail, because we still want to provide that data in a standardized format.
Great, thanks. So I promised you a wide range of companies, and I think you've seen we've got that here. Maybe one great place to start was just, again, to sort of bring out some of the contrasts. And Sam and Eric, do you even have personnel contacts in your database, and how important are they to you in the markets that you serve?
We do not. We do not track people. They have this nasty habit of quitting, dying. So no, we actually don't track people until they solve that problem. The only thing we track is we do track private equity, venture capital partners and investment professionals, mainly because we have to maintain that network anyway. But the universe of contacts is probably 25,000. So it's a rounding error for, you know, someone like Jimmy.
And I mean, we have names of executives within the database, but in terms of like contact information and that level of detail, we don't have that level of detail, but we do have names and executives and various
We get asked a lot about it, which is why I probably would invest in that prospect. Like, can't you add the people? It's like, you know what, if you have to be good at one thing and do it well, and for us, we're looking at the financial user, and while I'm sure we're turning away a lot of sales teams and that sort of thing, we'll just send them down the block to Jimmy.
Good, we've got at least one deal today on stage. It is kind of interesting, though, that I think you just put your finger on probably one of the most interesting aspects of private company data is, can anyone do it all, or do you really have to either give up a piece of the project or license it or get it from some third party? It's just feels overwhelming.
If you're looking globally, it's definitely overwhelming. I mean, you're talking about millions of companies. You know, for S&P Capital IQ, our public universe where we're sourcing, you know, we're collecting the data ourselves, you're talking about, you know, maybe 100,000 companies, if that. Active universe, a lot less than that. And then if you expand that to 1 million companies, I mean, that's exponential in terms of the number of companies that you have to cover. And you want to maintain that same level of quality, so you're going to be, if you want to be searching the notes in the documents and whatnot, and then you have to, there's translation issues as well when you expand globally. Mm-hmm. And that's another piece of the collection puzzle that takes a lot of time and a lot of resources.
And also because there's not one feed. I mean, you can knock out 18,000 of your 100,000 just from an SEC feed,
Yep.
right? So because you don't have that, to go from 100,000 to 1 million companies, your staffing for quality would go up more than 10 times.
Right.
Like S&P's staff would probably have to go up 30 times. So it would be, you know, disproportionate increase in the bodies and the level of sophistication even they need to cleanse, quote, data that's not coming from like an SEC cleansed feed, where you have lawyers at the SEC looking at it, and the class action, you know, lawyers, that will sue them if they're materially off. So, and then you have the real-time market, reaction. So you have so many self-correcting mechanisms that just simply don't exist with private companies.
Now, Jimmy, you've come at it more from a people-centric approach. Now, was that a conscious decision that you wanted to just focus on that piece of the market, or were there other decisions?
No, the company data matters to us, but I think what Sam said is right. You got to figure out what your comparative advantage is, and ours is people. There's no question. There's a whole set. These processes I described, people have figured them out for companies. They do it differently. They do it better. So the way I like to frame it is our atomic unit is a contact, and a company is secondary. It matters. Our customers care about companies. They want the firmographic information appended, but they're coming to us for contacts, and then we deal with the company data. Whereas with these guys and many others, their atomic unit is a company. They're very smart about how they do it, and you can hear the contact information is maybe an add-on at best. So the frame of reference is different. This just happens to be the core competency for us.
Interesting. Now, both of you two, I think, are very heavily onto the financial data relative to these companies. Do you also have deep backgrounders on the company as well? And is that even what your customers are interested in? Do they want to become instant experts on the company, or are they just simply screening to find companies that meet certain financial criteria?
We do have some profile information, but there are clients that'll just want to know, relative size of a company, and they just want to know a revenue figure that's good enough for them and a brief profile of the company. But a lot of our clients are digging deep into the financials, so they want quality level and a lot of detail and the most recent financials as well.
So. On top of that.
Yeah, I mean, we have our user is fairly sophisticated, so a good portion of them already know about the company.
Okay.
By the time they look it up on Prifco, you can imagine they've done a basic Google search, they've looked at the website, so we don't want to just regurgitate what's already there. Plus, it has this nasty habit of being perishable, right? They're in this business line until they're not. They own this subsidiary till they don't. Things like that. So we're mostly focused on the data, but for really high-profile companies, we will do, analytical discussion of the business model, its key sales channels, that sort of thing.
Okay. Well, it sounds like a mix, and you've got some people who know the company they're interested in are coming in to fill that missing piece.
You do have the junior people or a consulting firm that isn't a sector specialist, but they get hired to do a benchmarking study, and it's a fairly unfamiliar industry to them. They can use Prifco to even find out. A lot of them that use Prifco don't even necessarily know the company. They just know the universe of companies or the criteria, say. So using advanced searching, you can find peers to benchmark, for example, competitors that you weren't aware existed, that sort of thing, that meet those criteria.
That's interesting. The other thing that's kind of interesting to me, and I may be wrong on this, but it sounds like all of you have sort of gotten kind of all the companies you can, but do any of you say that we've got 100% coverage of X, that we've defined a specific universe and we've got everyone or mostly everyone, or is it more, I've got all the companies of this type, but I can't guarantee you've got the full universe?
I think it's so difficult to even verify that. We try to, we do say, we have 99% of public companies, but then when it comes to private companies, it's very difficult to verify, your universe in itself. So, I mean, we don't try to claim that at all, and I think it would be very difficult to even know how to do that, go about doing that.
So, Jimmy, what about your perspective? I guess particularly with that sort of crowdsourced model, you kind of live with what comes in the door, or do you put any particular efforts into flesh out industries or certain company size classes?
I would say yes and yes. So to a certain extent, we live with what comes in the door, but that was the purpose of that pie chart I showed, where we don't want to live with what comes in the door because it is random. So the research we do and the contacts we go out and collect, as I said, we know exactly what our customers want, and so we go get those. So for example, a typical customer may want to market to IT managers who have a job title of manager and above and are working for companies with a minimum of 100 employees. That's a pretty common thing. So we'll go out and make sure we find IT people who fit that profile, and we'll fill in as much as we're able to. So it's a little bit of both. As I said, there's a random component and a non-random component to it.
And you don't have people, or maybe phrase it another way, do you think there's an opportunity to say that is your data more valuable if we say we've got everyone who meets certain, or mostly everyone?
Yeah, I don't think we would make that claim either. That's a tough claim to make, and the data is dynamic. You know, as Sam was saying, people are here today, gone tomorrow, they move on, they die, they retire. So I don't think we'd be prepared to make that claim.
Okay, and there doesn't appear to be any real groundswell of market interest to have definitive knowledge of everyone in the
I'd say
company.
after you meet a minimum threshold, in the early days of Privco, you definitely had there's just not enough in this region, in this sector, that the total matches is 3 or something like that.
Interesting.
But I think once you meet a minimum threshold, I think it's dangerous and disingenuous to claim that you have 100%, unless it's a public universe, obviously, but to claim you have 99% or 100% of anything, I think would be a little scary, and probably would again have that increasing cockroach effect that doesn't, unfortunately, infect the private company data business, which is again the client, especially his financial client, maybe not a sales client, they have enough samples, whether it's a law firm, accounting firm that audits books, they have enough samples in their desk drawer. And they're going to check those first,
Yeah.
and if you don't get 5 out of 5 or 10 out of 10, down to the dollar, you've just kind of eroded the trust factor. One curiosity, by the way, you said someone wants to find a certain site. Do you have consultants on staff who will do a custom search for something like that?
Yeah, we could do it both ways. So we have a self-service option. You can just go to our website, you can do a bunch of selects, as we call them in our world, and you can download a list. You're welcome to do that. We don't recommend it. We have data specialists on our team, so you're better off calling us saying, this is what I'd like, and usually the customer doesn't know the details of how SIC codes work and searching on different ways of industry. And so usually they'll get a better outcome if they ask us, and we're happy to help them. But they can self-serve if they want to.
Right. You should, by the way, switch to PICS system, the Privco Industry Classification System. You can drill down to mobile apps, mobile payments, very clean energy solar panels, hybrid vehicles. They haven't updated that stuff in way too long. So PICS.
All right, it's working out very, very well so far.
Sam, you raised an interesting point a few minutes ago about this notion of critical mass. And Jimmy, I don't know if your history allows you to speak to this too, but what's it like in the early days till you get to whatever that magic number is when you don't have enough to make anyone happy?
I still think you stick to your guns, and I think the biggest, we're all in the data business. And we're here because we're part masochists, let's face it. Because you write a software program and say go, and it just sort of scales and leverages. How many of us have had someone say that that piece of data is wrong in your product, right? Right? I'm sure most of us have had that. And anytime that happens, damn it. But it's a tough business that we've chosen. But obviously we're here not because we want the easy money. I think you're looking in the wrong place. That we love what we do. We love information, we love manipulating, analyzing, crunching, what you can do with it. Once you get enough of it, you can track retention, how long people stay on the job for CTOs in Las Vegas or whatever. You could do all sorts of things that give you enormous sales insight, right? So what you can do with the data as well, I just think is fascinating. But the early days, I think the discipline is, only show what is confirmed, only show what, really stick to your guns and resist that temptation to go broad. Because there's always going to be those clients that turn you away because we're an international firm. We need stuff everywhere to justify a spend. And Hong Kong and London's not going to sign off on a US-only database and that sort of thing. Mm-hmm. And there's also the temptation of, well, can you go out and add these 8 companies, or can you go out and do custom work? And I'd say you resist that temptation because we're not in the management consulting business. Right? There are management consultants who use Privco for data, and they then package it and do additional research, and then they resell it for $100,000 and pay us peanuts. That's fine. But when we're now trying to take on that role as well, to be the benchmarking or the competitive intelligence consultant, That I think when it goes from data to professional services, and that I think is, that temptation is greatest in the early years, that you have to resist that.
Interesting. Do you have enough history to, was there an ever time when Net Prospects was just not big enough for people and they said, come back when you grow up? And
Yeah, the tension for us is a little bit different. I would frame it as we always want more, because the larger the list or the larger the project we do, the more money we make. So there's always a tension between quantity and quality. We can always boost the quantity by adding some substandard records. So the quality will go down, and that's a tension people in our world are well familiar with. And it's tricky because you want the client to come to you for everything that they need, but there's this ever-present risk about having acceptable quality. So we always want more. So we've never been at a place where the critical mass wasn't enough to open up shop, but we always want more, and we're always trying to balance the trade-off of quantity and quality. That's the way I would frame it.
makes sense. And Sam, I got to say, you left me kind of breathless during your presentation when you talked about that bar you set for yourself on quality, especially given the size of your database. Well, can we talk sort of, all of us, a little bit about quality and just how demanding the user universe is these days? I mean, some of us out here are saying we can get by with good enough data. There's some people who say that doesn't cut it anymore and we have to be up here. What's the environment like? What are customers telling you?
I think it has to start at the top in our organization. I do feel sometimes like I'm Steve Jobs putting a hammer through the Apple II. That's not good enough. No, but I have a very high standard. I'm a perfectionist. I want it to be flawless. And sometimes, I'm sure I'm not the easiest guy to work for. But to me, it's like I'm passionate about it. I am the user. And I know the level of precision I require. And don't tell me, sorry, I think they're in the room. But it's another database who had Facebook revenue before it filed for its IPO at 50 million. First of all, anything that's an even number like that is suspicious, number one. You have to be half brain dead or really unsophisticated user to even look at a number that's 50, point up, right? What are the odds? Second, there's no year assigned to it. Third, we know it's 3.8 almost for a fact because we have inside sources, let's put it that way, that confirm those numbers every quarter that they were on track to do that. And we filed for IPO was 3.72 billion, just under 3.8, not 50. Of course, we screenshot that and save it, lest anyone ask, why should I use you instead of them? But it's so unacceptable. But even if it were 3.1, that would be unacceptable to me. And it's unacceptable to me because it's unacceptable to our client. And again, we were blessed, as I tell our staff, to work with the smartest people in the world, the head of M&A at Google, right? Or buying companies based on the data at Privco and screening them out and contacting them and writing checks for $100 million. We're also cursed to work with the smartest people in the world because nothing gets by them. So I think in quality for us, it's an obsession in terms of quality. And I just think that won't go away. And at Data Content 2023, I'll be talking about how dissatisfied I am that we're not at 100% Six Sigma, but only at 5 Sigma.
Well, what's your experience been?
Yeah, it's pretty much the same for our clients. Quality is extremely important, and our users, they're always going to be somewhat skeptical of the underlying data, even when it comes to public companies. So when you look at public companies, we offer a click-through back to the document just because we want our clients to be able to verify those numbers. Now, when you get into private company data, if you don't have those underlying documents, you can't do that. So that's one of the challenges that we do focus, or we do realize sometimes just because we don't have those underlying documents, so we can't even verify it ourselves. So if we're sourcing it from a third party, we do have to rely on them, but we also, we do have that expectation of it being the highest quality data.
Is it different in sort of a sales marketing environment?
It is different. It's more nuanced. It's multifaceted. And as I like to say, I use a term that I don't like to use in public because people have a hard time with it, but it's somewhat probabilistic in the sense that a record that's correct today can be wrong tomorrow. They change, they move, they change their address. The person quit his job. And so we manage it in a multidimensional, probabilistic manner. So we need to track, is the job title right? Is the phone right? Does the email deliver?
Is he alive?
Is he still alive? Has he moved on? So it's yes, it's very important to us. We track it in all sorts of ways. It's not so simple for us to say we strive for 100% quality because we know it's not. We know things are dynamic and they're shifting every day. And so what we want to do is track it on a regular basis, know what it is, and ensure that we maintain it at a high watermark that's acceptable. So, but it's not as simple as saying everything is right all the time.
I think the client will cut some leeway that the person left, say, 3 months ago. You know, if it happens 1 in 100 times. That's just my sense, but you know better than I do. You know, I think they expect a certain error rate, but when it's there I think for the financials though, they don't really expect an error rate. And in addition, by the way, companies die too, right? They go out of business, they get acquired, they also go public. You don't want that, you know, there's a Twitter logo there, and you know, mental note, on November 15th, the Twitter IPO date, by the way, scoop for you guys, Friday, November 15th. And I know that day, that logo better be gone, and in Prifco, Twitter better be public stock, and it'll now be in, you know, Eric's domain. And, you know, we bid them farewell. So you can't even have them in there for, you know, a week as a private company, or you can't accidentally get a subsidiary of a public in there. We're talking about a lot of different moving parts. Not as many as people, but the stakes are much higher, and the level of precision expectation is much higher. So.
And you don't get a cut or break because the information isn't available anywhere else. Even though you're the sole source, they still want it perfect.
Correct.
I think that's another challenge that Sam mentioned with like the subsidiary level financial data. A lot of times when you get private company financials, it could be unconsolidated, or it could be consolidated, or you could even get a subsidiary reporting, you know, parent level financials at the consolidated level. So when you're analyzing, you know, company A versus company B, and one's consolidated, the other's unconsolidated, and you can't verify that, then you're really not looking at, you know, true comparable companies.
Interesting. Let's talk a little bit about tools, because we've talked about this incredibly precise, demanding data that you've built. Have you surrounded it with tools? Is that a big part of the offering to your audience, or is it really the pure, raw, perfect data itself that's the sale?
In our case, people want both. Some people come to us, they just want to buy a list and they're happy. In other cases, as I mentioned, we have a whole suite of tools that people can use to analyze their own data. So the best example of that, and the most recent, is we built something, a free tool right on the web called a data health scan, where you just upload your marketing data. And we do a pretty remarkable thing. You can upload 100,000 records, say, for example, and we will give you this analysis, this medical checkup, in about 15 minutes and tell you on an aggregate level what's right, what's wrong, where you have to focus, do you need to worry, how many dupes you have. So most of our customers love those kinds of tools because we're making it easy for them, and that happens to be free. But others just want to come and get the data and move on their way. So we make it easy for you to do either of those.
And you're doing a lot of back-end scrubbing as well. We're moving into that?
You know, the back-end scrubbing never stops. We're always,
I'm sorry, cleaning client databases.
Oh, yes. They send us their data, we'll clean it for them and send it back. And we have tools. In our world, the big play is not the CRMs like Salesforce, but it's the marketing automation tools like Eloqua and Marketo, if you're familiar with them. So we have tools, we can go right into those automation systems, get the data, do our cleansing, and put the data right back. So those are the tools that we offer.
And how deeply are you into tools around your data?
I mean, I think for most of our users, having the data, they're surprised. But there's no question, we have, you know, all sorts of tools that are in development. You don't want to overload it with tools and lose sight of the data, because, you know, we have a hard enough job. And also, again, as you build critical mass, we're there now, but as you build critical mass, you also want, for example, search is so advanced that the results are 1 or 2. It's sort of like, you know, Vault early days or job search, you know, jobs board or database, which you didn't want so many search criteria that, you know, when you got to a search in Milwaukee with all those criteria, you know, there's one matching, you know, employer or job. But I think those are just going to be layered in over time. I think for public stocks, tools is everything, right? Because ultimately what differentiates, S&P from Bloomberg, from Reuters is they all have the same feed more or less. I mean, simplifying it, but you know what I mean. And the tools are everything in many ways. The customer service, pricing, of course, the technology of the platform. For us, it's mostly about the data. They'll forgive, I want this additional search criteria, or forgive user interface type of things. I'm not saying they don't matter.
Right.
It's just that they matter less to somebody who's a hardcore finance user. Is not going to tell you that blue is distracted.
Got
It's
it.
not really what they're focused on. But of course, over time, each day, layering in more.
Got it. And you're pretty strong on tools?
Yeah, I mean, we try to offer the private company data in the same tools that we offer for public company data. So we still offer, the private company financials in our standardized format statements that are similar to our public companies. You can pull the data in Excel as well. And it's also offered in screening, which is another challenge as well, because in screening you have the ability, unless you have that additional filter where you filter out public or private companies, when you're mixing the two data sets, you have to be careful of the data that you're retrieving. So that's definitely a challenge, whether or not we want to filter out certain private companies from screening, because they're a lot more visible when you screen. If you're going to screen on companies over 50 million and you include private companies, all those companies will be visible. So we want to make sure that data is accurate. So, or companies over 50 billion, where you might get a private company that's, shouldn't have revenue over 50 billion, but it does.
Yeah, yeah.
And that raises a red flag. So.
And do you ever have people coming to you and saying, hey, I love it, I want it, I'll take the whole database, send it over, and they want to just incorporate it into their internal systems?
We've had a couple of those. Yeah, but that's not really what most of our users are like.
It sounds like
it might be like an academic doing some PhD level empirical study or something like that. That's not really what we're for.
Mm-hmm.
We're not for just we want every data point. It's just generally not appropriate, or every data point for a country or something like that.
Yeah.
Every company, no matter what industry, what size. So generally speaking, no. We do get some of those like out of left field requests, but generally no.
Yeah. And you wouldn't do it if they asked?
No.
Okay. Last question, and maybe we'll take a few questions, but could you offer any lessons learned to the audience and what's involved in collecting good quality private company data? A lot of companies here are doing it in a specific vertical. Maybe little tricks or things you should avoid doing, any guidance you could throw out there? Things you wouldn't do again now that you're smarter?
Well, it's not core to your business. I would say, don't try to perform surgery if you're not a surgeon. There are just so many moving parts. And the only thing worse than having no data on a private company is to have the wrong data and think it's right. So I would say that tread cautiously and probably go to a provider. Again, none of them are going to be perfect except Privco, but you still should go to a provider of data that has put in the investments and the time, and that's something you're not going to just be able to replicate on your own in-house. And if it's not core to your product, which for most people it isn't, that should be left to the professional.
Any thoughts on?
I would tend to agree with Sam. It's a hard problem. Why would you want to attack it if you don't have to? The other thing I would add is, and I know people don't want to hear this, I would set reasonable expectations for what's achievable in terms of coverage, in terms of quality, in terms of freshness and updatability of the data, because it's a tough challenge, and it's a big world out there.
I agree. I mean, we're in the learning process of just going through the various sources and what's out there, and we generally work with other third-party providers of the financial data ourselves. So we're not even we collect private companies with public debt, and that's currently that's our only collection of private companies. A lot of times we source it through third parties, but there's still that quality expectation. So you still have to analyze what you're receiving in that data.
So it's not easy. I think we can squeeze in a couple questions, although I can't see anything. All right.
Is it that depressing?
Scared everyone off.
Hi, this is for Net Prospects. I realize there's a lot of privacy rules, but do you have any plans for expanding to international markets?
Yeah, very good question. So we do have international data now, so we've already expanded. And you're right, the privacy rules in terms of email marketing vary country by country. Some of them are very strict in Europe, you might imagine, and others are more like we are. The UK, for example, is more like we are, but you probably don't want to do a lot of email marketing in Germany, for example. So we already do offer international data. It's tricky for the reasons that you raise.
Kathy?
Hello? Okay, you talked a lot about quality of data. What about timeliness of data? How do you handle the SLA of speed of updates?
So for us, I mean, for a lot of our private company data, we receive a feed. We actually don't have any SLAs with our actual clients, so that's one good thing. For the public company data that we're collecting ourselves, we basically have a short time frame that we agree upon. But for the private company data, we try to manage expectations because private companies aren't going to be filing as frequently as public companies, and a lot of the data is financial data is annual data versus your public companies that have interim data.
For us, the freshness is critical. Our data is decaying every day. We're very aware of that. And our accuracy model, I didn't talk about, but the more of the details, we have an accuracy model where we assign a score to every record. And that score automatically is decaying at 2% every month due to the freshness of that going down. We'll then re-verify the data on a regular basis, but we're very mindful that the leftovers in the fridge, if you could excuse the metaphor, are getting a little less tasty every day. And we constantly need to refresh them and get fresh contacts in, and we have a score that's reflecting the age of that data.
And you actually publicize that score, don't you?
We make that score public to users if they want to use it. For a lot of them, it is confusing, but we don't hide behind it at all.
Great. I guess we've got us a session. Thank you very much. That was a great session, and learned a lot.
Thank you very much. I'd like to invite our next panel, Jerry Mintz, in the Driving Dollars with panel, to come up to the stage, please. Do you need, we need you over here to the next panel. Yeah, if you can just head over there.
Guys up. They're just doing it now, so. Just grab a glass of water here.
I guess we're just about getting started. I think we do.
No, that's not it.
There we go.
Okay, good.
And just to remind everybody, for those of you
I'll
participating
sit over here
in
so you guys
the
can
one-to-one business connection meetings, that will be held during the break. So if we're running a little late or a little early, the meetings will start when we break. So I think the program might say 3 o'clock. We won't be starting that at 3 o'clock. We'll be starting the next round when we officially go to the next break. So Jerry, I think we're all set, so I suggest you get started.
Waiting for one guy, but let's get a start. Good afternoon. It's a real pleasure to be here. I'm Jerry Mintz of Percepta Partners, and I think we have a really interesting panel for you today. And I will, once everybody's mic'd up, I'll shortly introduce the panelists. This session got cooked up when Russell Perkins and I were talking in January about this conference, and observing that in the financial services industry, the technology has often been adopted very early in the cycle, because the financial services industry is the purest case I know of turning information into money. That's what they do for a living. And so they're always early adopters of advantages, whether it's a speed advantage or a data processing advantage or an analytical advantage. And there are lots of really interesting examples of how the industry has not only leveraged the technology, but how the industry has actually changed as a result of the presence of the technology. So the idea that we came up with was to bring up some examples to put in front of you of how things are being done in financial services, where is the technology in terms of processing huge volumes of data in real time? Where is the technology in terms of, producing millions of pieces of data on prices of securities every day? And where is the technology around news? To bring those examples from some leading experts and help translate what some of that means into the kind of rest of the B2B industry. It's interesting to reflect that, I've been in this industry a long time, as have many people, and comment was made earlier, suddenly the information industry is hot. Everybody's talking about it. People are all aware of what's possible to do with data, and they're starting to think about how to use this in their organization. So I think it's a great time to look at some examples of how people have been doing it for a long time are doing it. So to help us all understand this, we have a terrific panel here. My immediate right, and I'll let them introduce themselves as they speak. My immediate right is Peter Langford. Peter is the founder of STAC, which is essentially a testing and benchmarking organization set up in cooperation with the industry. And STAC has really become the standard of measuring the performance of high-frequency trading systems, of low-latency data products, and increasingly now big data. And one of the interesting dynamics is that organization and the products being used in that sector are starting to make their way into the B2B industry. And Peter, prior to STAC, was at Reuters, and he and I had the privilege of working together there. To Peter's right is Mark Alvarez. Mark is a senior director of reference data at Interactive Data. Interactive Data is going through a huge transformation now from essentially a batch-oriented process to a real-time business, and Mark is the architect of much of what's going on there. I think it's a fascinating story about how a whole industry is changing and how they are changing with it, and will be part of the change that drives the industry. Mark also was at Reuters for a number of years, as was I, and as is our final panelist, Adrian Dixon. Adrian is the VP of content for a startup company called Qbeats, which is doing some really interesting things in the news space and adapting some interactive and dynamic new pricing models to price the content in real time. And Adrian is going to talk to us about some of the innovations going on in that space. And Adrian spent most of his career as a journalist at Reuters, was responsible for a number of major aspects of their business. So he's got a great background in that. So without further ado, I'm going to turn it over to the panelists, each one to talk a little bit about their section, and then we'll talk about some of the themes as they relate to the broader B2B information space, and give everybody here a chance to ask some questions. Peter, you're up.
Thanks, Jerry. All right, so Jerry gave you just a quick synopsis on STAC. We are an information publisher. You can think of us kind of like Gartner, except with some important differences. Number one, we're much smaller. Number two, we just focus on the financial markets, and in particular the engineering challenges, the real sort of cutting edge engineering challenges in the financial markets. And the other difference is that we facilitate this industry group which develops the standards by which we test technology and we get our hands dirty and provide data from actual testing. So I'm not going to talk about my company in this. I'm basically going to talk about some of the dynamics in information and information technology in the financial markets. As you can tell from the punish title there, early bid gets the worm. This is largely, but not entirely, about speed of information. So my current vantage point at Stack and also my previous role at Reuters, which Jerry alluded to, makes me pretty familiar with this topic. And the purpose of familiarizing you is to draw some parallels to trends that we see emerging in other areas of industry and contemplate what kinds of opportunities that might mean for some of the people in this audience. So one word summarizes all the trends I'll talk about today, and that's automation. Now, when most of us think of automation, we think of factories, and we think of farming maybe, and mining, where now those massive trucks are actually remote controlled, or warfare for that matter. What a lot of people don't realize is that there's been an absolute revolution in the financial markets due to automation. And lest you get, weepy-eyed over a bunch of traders who've been displaced by machines, they're still doing okay. I'll explain that in a minute. But what we're talking about here is not just electronic trade execution, not just people clicking a screen and having the trades done. It's the actual trading decisions being made by computer algorithms. Of course, there's somebody behind the curtain, sort of putting boundaries around that. But the real revolution is that the trading decisions are being made by machines. And there are a lot of reasons for this. There's regulatory changes, and recessions have had their impact on this, and a lot of different things which we don't have time to go into. But clearly, one of the long-term forces behind this is maturation of the enabling technology. So how has this affected how trading is done? There have been big effects on market structure, where trades get done, how the market what's the division of labor in the market. So in the last decade, the activity in the liquid markets like stocks and FX and so on, they were all concentrated among large brokerages, and the trades were executed at very few exchanges. You had NYSE and Amex and a couple others. Today, the trading activity is dispersed quite a bit. Brokers are still involved, although the role has changed a lot. It's really thinned out. And there are numerous small proprietary trading firms that are handling a lot of the activity that the brokers used to handle. At the same time, the execution of trades is now dispersed across a whole lot of places. So instead of having just a few exchanges, there are something like 40 or 50 places where you can trade stocks in the U.S. A lot of them are what are called dark pools. They don't publicize the prices from their trading, but there are also a lot of sort of startup exchanges and so on. And this is one of those. This is actually an effective regulation, and it is also one of the things that's driven automation, because you can imagine, how do you keep track of all these different places to trade? You've got to have systems that can figure out what's going on in all of them, decide where the best price is. Many of those small firms I mentioned are engaged in what's called high-frequency trading. And some of that was started by those traders who lost their jobs. So things kind of come full circle. And you've probably read about high-frequency trading, HFT, in the press. So I have to talk about it. HFT is not really a different trading strategy. It's just a whole heck of a lot faster. So it's basically what middlemen have always done in markets. They're buying and selling constantly, trying to buy low and sell high, hopefully. And in high-frequency trading, this happens thousands of times per second. Okay? It's all done by machines. And they're making pennies or fractions of pennies on each trade and hoping to make it up on volume. So that's what's driving a lot of the volume. Now, I don't know if you can read the slide there, but basically this chart on the left shows the proportion of trading that is, this is equities trading in the US, the proportion that's actually high-frequency trading. And I think this may actually be overstated a bit. It may encompass all of automated trading, which is broader than HFT. But in any case, the trend is clear. There's a huge proportion of trading is being done by machines now. Machines instead of humans. And you're seeing the same trends in foreign exchange, in options, in futures, basically most of the financial markets. Actually, one of the consequences of Dodd-Frank, which is to force some of the instruments that used to be just traded over the phone onto exchanges, may drive more automation in those markets as well. So the chart on the right, though, shows what's happened to profitability, and there are a lot of reasons for this. It is still a profitable business, but there are fewer players who can make money at it. One of the reasons for this is that it's a very competitive business. Once you have a technology-driven business, then it precipitates an arms race, and it can be difficult to keep up. The good news is that all this competition has been good for the average investor, at least many people think so. There's a lot of controversy about this, but I thought I'd throw this in. This is the median spread over a several-year period during the big thrust of all this automation. The spread is the difference between what somebody wants to sell a stock for or buy a stock for, and the difference is sort of their profit if they're a dealer. And the spreads have come down, which most economists would say is a good thing. It's basically reducing the transaction costs in the market. See the same thing when Tokyo made their exchange amenable to automated trading. You saw an immediate drop. I think the spreads went down by like a third. But anyway, automated trading is more than HFT. There are lots of different reasons that firms use machines to do their trading. I guess the last point is just that it's popular in the press to frame the trend here as these HFT firms versus the regular investor. But the fact is that if you're a pension fund or a mutual fund or even an active retail investor, you now have the same kind of tools to trade algorithmically. So it's really a pervasive trend across the industry. So what impact has all this automation had on the market players, or for the information needs of the market players? In the last decade, it was pretty simple. You had your Reuters, your Bloomberg, and a few others who provided data to humans who were making all these decisions. They had their Bloomberg terminal or their Reuters terminal, and that was pretty much it. Today, the key for this kind of trading is very low latency data. Low latency meaning very fast data. They want everything to be machine readable so that these trading algorithms can make decisions on them. So that's not just numbers anymore. It can be news, it can be dates, and so on. And finally, because these algorithms are based on, they're making decisions for the present based on the past, there's a huge demand for historical data. And in this case, it happens to be really granular historical data, time-stamped in nanoseconds. Actually, that leads me to talk a little bit about this whole latency thing. So just to give it a little bit of color, this is a slide that we update every couple of years on latencies in this industry. So back in those days I was talking about where it was mostly human-based trading, the time between information being generated at an exchange and its consumption by the decision maker could be hundreds of milliseconds, so maybe a quarter of a second. That was considered fine, right? If I had the information that quickly, a fast trader could make a decision and click a button and make a trade. Those days are long, long gone. Now, we went through a wave of different technology innovations that kept driving that limbo bar down. So one of the things about this game is there isn't really, except for the laws of physics, there isn't really a barrier. There isn't like a point at which everyone says, okay, we now have acceptable latency. It's an arms race. You have to be at least as fast as the other guys. So nowadays, we're at the point where the information truly needs to get from exchange into the trading application in microseconds or less. Microseconds being millionths of a second. And we've seen a pattern here where every 2 or 3 years, the acceptable latencies go down by an order of magnitude. So that's how serious this stuff is in the financial markets. What impact has this had on the information industry? There have been losers and winners. It's been a classic case of creative destruction, to use Schumpeter's terms. Basically, the losers in this have been, first of all, consolidated data feeds from the big vendors. That is not to say that business has gone away. By no means has it. And in some cases, there's more demand for consolidated feeds. But they've been hit by some very simple physics, and that is that the time that it takes to pull in information from all the exchanges, normalize it, and then redistribute it out to customers all over the place is just no longer acceptable for this kind of automated trading. So there's been some hemorrhaging in those consolidated feeds and disintermediation, because now people go directly to those exchanges for the data, which I'll talk about in a second. The other loser in this has been, over time, has been the traditional display application, the human-oriented tools, simply because there are fewer butts on seats, just fewer traders. There have been a lot of winners, though. So one of them I mentioned already is exchanges. So these are the source of much of the data. And it didn't take them long to say, aha, there's an opportunity here. We can go directly to these consumers of our information and feed them directly. We no longer have to go through middlemen. The end users were demanding it because they wanted the data faster, and the exchanges saw a profit opportunity in it. So today, for most exchanges, a big proportion of their revenue comes from the market data that they supply. And some, in fact, like NYSE, for example, have figured out that because they also have feeds from the other exchanges, that's something that's required by regulation, they're starting to provide their own consolidated feeds out now to compete with the vendors on price. So it's gotten a lot more complicated for the data vendors. The exchanges have also exploited another phenomenon. And as I was thinking about this talk, I was reminded of years ago when Jerry and I were working together. And it was just at the very beginning of all this low latency stuff. We're sitting in a meeting and talking about how these customers want direct feeds from the exchanges so they can get faster data. And I remember Jerry saying, well, hell, if they really care that much about the speed, why don't they just move their applications to the exchange? You know, it's the mountain to the Muhammad kind of thing. And you know, the irony is that within a couple of years, that's exactly what they were doing. It's called co-location, where you put your application at another site to reduce the time it takes for the information to get between you know, the information source and your application. And the co-location hosting business is huge with the exchanges. They have massive data centers where their members put their own applications. I mean, and there's all sorts of fighting over, you know, whether the guy down, you know, in this cabinet has a longer cable connecting him to the matching engine than you do, you know, because that's a few nanoseconds of latency, and it's crazy. But the exchanges have been able to take advantage of that. Machine-readable news has been big, making that content consumable by applications. Sentiment data, it's quite important now for trading. And the ability to put all that into history and analyze that, it's been huge. Oh, and finally, and software. You know, you heard Jeanette from IBM this morning talking about how important software is to integrate information. That's been a huge business out of this. So what's the relevance to you guys? I'm fond of a quote by William Gibson that the future is here, it's just not evenly distributed. So I think that what we're seeing in financial markets may be the future for a number of other industries. In fact, at Stack, we call this the algorithmic enterprise. Basically, this is the concept here is that there are a lot of industries, and in fact, it sounds like IBM is one of them from Jeanette's talk this morning, where they're increasingly automated, they're increasingly dependent on analytics for doing business, and the time sensitivity of the information and the actions based on those analytics is getting much higher. And I think, I wasn't counting, but I think she may have said real time maybe 12 times in her talk this morning. So we're coming across many examples. I've listed a number up there. I don't have time to go into them. But I think these transformations in these other industries will present opportunities for new kinds of information and services, and maybe you guys will be the ones to exploit them. So my advice is number one, to think about how you can add value by structuring unstructured content, because at the end of the day, robots want structured data, not unstructured data. You're used to thinking about the value of your information. Also think about the value of changes in that information and the speed with which you can communicate those changes. And if there's value in that, then there's probably value in having history of those changes. And finally, there's likely to be a big opportunity in software. And don't just think about dashboards and eyeballs, because in this kind of market, your audience is no longer a human, it's a robot, and they have different tastes. Okay, thank you very much.
Thanks, Peter. Mark, you're up.
So I guess it's time to hear from one of the losers. So it is true, we all worked at Reuters, but I'm much better now. So I work with Interactive Data. We are the third largest global vendor in the world. We operate globally. We have offices in over 30 countries. We run 24/7 capital markets data collection and distribution. In 2013, we're closing in on $1 billion revenue. We are the third largest data vendor, and the other two I won't mention, except to say they're scoundrels. So you've heard a lot of what's going on in terms of looking at things from the technology side. And if you look at what's happening in the industry around us, it's pretty clear that we in the data industry for the capital markets are really witnessing some pretty profound and tectonic shifts in the industry. And really, my background's in economics. I'm not a technology guy, but what you're really seeing is the impacts of globalization. I can't think of an industry that is more globalized than the capital markets, and you see this now in many, many different ways, such that things like the technology changes Peter was talking about are really what's driving the ability for people to produce profit exactly to where it should be, which is at equilibrium, which should be, net effect close to zero. So this is a fundamental change to the industry, all this efficiency that's being introduced. And in the capital markets, we have the concept of alpha being the rate of return over and above what you could get by putting your money in a pension, in a bond or something. And alpha is what drives profit for organizations, banks, brokerages, private equity firms. Any participant in the capital markets is looking for alpha. And because the markets have globalized now, the route to getting alpha is by introducing much more sophistication to what you're doing. And that means taking positions perhaps in securities you've never been in, taking exposure to currencies you've never heard of. You can believe some of the stuff we have to deal with. You might execute that strategy not by buying the actual instruments themselves, but by buying a derivative contract that references. And what goes along with this, if you stop and think of this from the data lab, is this just orders of magnitude of an expansion in the data content that's required to keep track of. And guess what? The need to manage risk goes right up in lockstep with it as you take more complex positions across more geographies, across more currencies. You need to measure and monitor and take action on the risk that goes with it. So everybody in the industry is now starting to have to embrace their inner statistician. I know you didn't like that course at university, but trust me, you got to go dust off the textbook. It's becoming a highly empirical world that we live in. So really, when you think about what that means for our customers and what they're asking us to do is they don't necessarily know. It's not a discrete question to say, what is the data that I need to power an application? They actually need to know what our entire universe is, and it needs to be ready for them when they need it. This is a very profound change in this industry, which used to work very much on a batch basis. We would publish files, and people would parse out files and load their databases, and very few to any standards exist in this industry. Well, that's not true. The nice thing about standards is there's so many of them. But a lot of conflicts, a lot of differences. So this is something that's really what's changing the landscape. And if you would look at this traditionally as to how people purchased, acquired, and applied content in their firm, it's a pretty sophisticated workflow. You figure out what data you want. You come to a firm like mine. We ship you a bunch of files. You then chop those files up. You almost always stick them in a database. And then you do this with other sources of content, and you put it through the meat grinder, and then you have lots and lots of meetings, and you have lots and lots of fights, and you blame your data vendor for everything. But eventually what comes out of it is a report or some sort of application of the content. And in the worlds that you're working in, you know, where your content that you're publishing is being blended with other content to produce value, you're going through exactly the same workflows. So what our customers are saying to us today, though, is let's get rid of the middleman here. We should be able to, as your customer, leverage your core competences, and those core competences are about acquiring, managing, integrating, and serving up data on demand. So this is where we're pushed. This is where we are pushing with our new Apex line of products. And it's really about, instead of figuring out what data you want, it's figuring out what analysis you want to run. And already knowing in advance what it's going to take to push the data content into those analysis. And what you find in financial firms is data flow, content coming to the organization is really a fundamental input to the business process. So guess what? We land smack dab in the world of big data. And the economics are kind of scary. Because when a firm introduces and invests in the infrastructure and people and other overheads, they almost always assume this is going to be a linear cost curve. Right? So they bring in their first data feed from us, and then they bring one in from somebody else, and maybe they bring in some unstructured content from yourselves to try and bring it together. What they actually find is, as the complexity goes up, the operating overheads go up. And from a business perspective, what they need to do is work with somebody's scale and capabilities, and partnering's big in this, so I think there's a lot of opportunities coming up, to really try and bend those cost curves down, because the difference between where you're going and where you'd like to go is serious, serious money. So we've learned a few lessons over the past few years. A lot of these are in response to the technology shifts you've heard from Peter. Our firm operates in both the real-time world and in the reference data world. And the first thing is, it was interesting to hear that my customers are robots. I'm not going to, the guys at JP Morgan aren't going to like them when I tell them that. They're not going to like that at all. But what we do at Interactive Data, we're a big data company. We take data that has no structure and we impose structure upon it. We push it out. We make it available through databases and feeds and things like that. But we reread prospectuses and convert that to digital data. We read press releases and convert that to corporate actions announcements. Bringing that into a single, easy-to-navigate structure is vital. Something that embeds conventions and standards and navigations that we can apply to the data and apply consistently is really important in getting our customers economy of scale, because what they really want to do to be really efficient in this industry is you want to reuse your content across your organization. The phrase we use is they want to use it and reuse it. Some firms would abuse it. And that just drives you to the entire consumption model. So traditionally in this industry is dominated by proprietary interfaces, so file formats, feed interfaces, various feed protocols. Everybody's got preferences on technology, whether you're a Microsoft shop or an Oracle shop or whatever. What's really important is that technology standards do exist out there, and they are vital. And in this industry, if you're performing a calculation on financial data, 97% of the time on Wall Street it's done in Excel and only Excel. So being able to support those interfaces natively and elegantly is really, really vital. And probably the most fundamental change that's happening within our organization is it's all real-time data now. Some of it just updates a bit more frequently. It's the change into our universe of content. So if a rating on a bond changes, identifying and notifying that change to our customers is incredibly important. And a dividend announcement coming up will trigger tens of thousands of calculations inside a firm if it's a big stock that pays dividend like a Sony, because that's in a cash flow analysis across the whole firm, whether it's in an index or an arbitrage strategy, whatever, it is used and reused across the firm. So everything we are doing in Interactive Data is to move from being a batch-oriented, file-based organization to a stream-based, event-driven, real-time organization. And really, we just have to move with the times. Files are great. It's a great business. We've been in that business for many, many years. We'll continue to be distributing our content through files, but it's only one of many different distribution channels now. A lot of what's happening in the industry, a lot of the new firms that are coming out are really internet-based firms. They're brokerages and banks. They're coming up on the internet every day. They're all data-driven organizations. They are used to working with internet technologies. They look at you funny when you come to them with here's a fixed blank file that somebody came off a COBOL mainframe or something like that. It just doesn't work that way anymore. So you have to move to this, and that goes from just literally data transfer through actually hosting and running applications on behalf of our clients. So it's a pretty interesting time, and fueled by the arms race that Peter was telling you about. So I'll leave it at that, and over to you, Adrian.
Hi, well, thank you very much. And thank you very much, Jerry, for introducing me as a journalist. I've been a journalist for most of the last 23 years, and it's been less than 6 months that I've been working for a technology company. And being a journalist is a little bit like being a Catholic priest, no matter how badly you behave, you can continue to call yourself a priest, and I can continue to call myself a journalist, hopefully. And I think this is the contribution that I bring to my company. I guess the other point that I'd make is the purpose of this particular panel is to talk about how to profit with data. We are a startup, and we still haven't launched our product yet, so I think it's a little bit rich to call ourselves, that I should be standing here telling you how to profit. However, we think we've got a really exciting product. We hope that it'll become a household name, that all of you will be users and you'll be familiar with QBeats very soon in the future. So, at first blush, what is QBeats? And in a lot of ways, we resemble a lot of the online news and information companies that are already out there, LexisNexis, Factiva, ISI, Emerging Markets. It's a pretty crowded field. But that's pretty much where the similarities end. And what really distinguishes us from a lot of our potential competitors is the fact that we have a pay-per-view business model. In other words, that you will only pay for the content that you actually use, that you actually read, download and read. And that the price on our, and I haven't started this, that the price on our stories will only be viewed, will be put next to the headlines. And that's an image there of our GUI. We've started off working with the financial services industry because this is an industry, as my two colleagues just pointed out, that is really accustomed to paying for information, understands the value of information, and we've identified certain areas within the financial services industry that we think we have an opportunity. So our first market was the commodities and energy market. There are a lot of small niche publishers in the United States and around the world that don't get a lot of access. Some of them are behind paywalls. Some of them have subscription models. Some of them rely on advertising models and so are therefore free to air. And so what we do is we work with them to ensure that they get their content onto our platform, and we work to extract the value from their content, and because we know who our customers are, and we understand what needs of our customers are, we get greater value out of each one of the stories they produce. I think I just want to underline one item. Until now, because the business models of the industry have been largely advertising, and if not advertising, they've been subscription or they've been paywalls, we understand what the value of the product of any news organization can be, but we've never been able to know what the value of one individual piece of content is, be it a news headline, be it a story itself, video, or even pictures in the future, and possibly also data heading into the future. Just very quickly on our business model, whereas most of our competitors work on a subscription model, we are on the pay-per-view, and so we don't give our partner publishers a minimum. We work on a revenue share that's 30-70 revenue share, where the publishers get 70% of the revenue share. They actually like it. They like the model very much, and I've been delighted that we've been able to contact and bring on board as many publishers as we have. And for them, there are several advantages. One, being on a platform such as ours allows them to reach an audience that's much broader than the audiences to which they traditionally reach out to. Ours is a cash business. We are, to some extent, we have a model that's the easy pass of the information industry. We ask any of our customers or our individual customers who have a credit card and $25 to take a credit, and any story that they purchase off our platform will be discounted from that $25. Obviously, some of our publishers have content that will be much higher than $25, and so in those cases, they'll have to take some more. The other advantage that they have is they get terrific analytics that they wouldn't normally be getting elsewhere in the market, and they're not able to get on their own. And particularly valuable because they're reaching out to a much broader audience than what they currently have. So I guess the other point that I should raise with you is we're going to be heading into two different audiences. One is institutional customers. And we have signed up an agreement with the New York Stock Exchange, which enables us to reach out to 2,500 institutions around the United States. This is really, really important because a lot of other information providers that distribute over the internet, for compliance reasons, have trouble reaching a lot of these institutions that only distribute news and information and data over the networks. The fact that we're on the New York Stock Exchange network means that we can go directly into their trading rooms. And I don't think, certainly not for the first few years, we will be competing against IDC or Reuters or Bloomberg that have large volumes of information on them. But we will be able to support back office or niche teams within those banks and those institutions that need the specific information that we are able to provide for them. So a little bit on the economics of news. What we have here is a value time curve of news, and the truth is the point that news is most valuable is immediately after it has been published. And who are the organizations that take most advantage out of that? Well, as you can see on the screen, it'll be either Bloomberg, Reuters, that are set up particularly to do several things. One, cover those markets, and they do so with their own teams, but they also have contributors from outside, and they have a worldwide footprint. And for every government lockup or any company news release or results release, they prepare sometimes several days in advance to know exactly what it's going to be so that they can get that information out in competitive timings. And like Peter was saying, those timings are measured in milliseconds. And next, who benefits from this? Probably the publishers who have subscription or paywall models. Those customers of those subscribers are probably not trading on the market, although they may be doing so. And then there is everybody else and the publishing on the internet. So what's the trend that we've seen? And this is something I'm sure you know. Because of the multiplicity of sources and publishers that have gone out there in the last few years, because the barriers to entry have reduced so dramatically on the internet. And because, and probably more importantly, the overwhelming model for business in the internet has been advertising. It has depressed the price of content. So what we're trying to do is we're trying to challenge that. And the problem with advertising is that it commoditizes news. Every news item or every piece of information, it doesn't discriminate between the two. And there is information that is either a forecast or anticipating what future asset prices should be much higher and much more valuable than a story that is simply recounting something that happened in the past. An advertising model does not discriminate against that. So this is what we're trying to do with our customers, and this is how QBeats, with its pay-per-view model, is hoping to begin to transform that. So what we do is we work together with our customers, and we have a deep analysis of how they produce their news. We look and see whether we can develop a time advantage in the release of their news. Some of them are already primed to release their information in a real-time format. Some of them do a lot of polls and surveys. Some of them are very focused on producing content which is forward-looking and producing forecasts, and all that is extremely valuable. And if you can highlight that information, we can embed it into our algorithm, and that will be reflected on the price of the story. Yes, our algorithm just will continue to drop. The most valuable news item will be that immediately after publication, and it should be a declining curve, except in those cases where the market realizes that one particular headline that's been published on QBeats is recognizing an awful lot of demand from other traders. And they will know that because on our GUI, they will see that the price is actually, instead of going down as they usually anticipate it to do, it'll start going up. And traders being traders, as they start, when they see a price going up, they'll say, aha, I need that story also. And so there could be real opportunities for the publisher. I think it should be quite transformational in the market. The result of this is that we're going to have a big pool of content, and for the first time, we'll be able to make predictions of what the value of any individual story or piece of content would be. Video, podcasts, you name it. And I think there are a lot of derivative products that we're beginning to look at that are related to this. Machine-readable news that Peter was talking about a minute ago is obviously one of them. I think another opportunity which is really valuable, and we've already been approached by some of our conventional newspapers, is that we embed an API of the QBeats business model into the newspapers, into the websites of their newspapers. And probably not for every one of their stories, but for the most valuable stories, those stories that really distinguish themselves, where they've had a lot of research, where they're making some kind of a forecast as to what will happen in the future. This will not be relevant for the customers that already subscribe to these newspapers or who are already taking their information behind a paywall, but it will be completely relevant to those who don't subscribe, who do go into Financial Times, the Wall Street Journal, the New York Times, and want to read that particular article that everybody is talking about, but they don't have access to that day. There's several other derivative products. We think there's a real opportunity with the blogging community. Right now, most of them rely on an advertising model, and they make minimal profits from it. If you're blogging, you're probably blogging because what you're interested in is influence. And we think there's a real opportunity, not perhaps for every blogger, but for those bloggers that have a real following. And in every walk of life, yes, perhaps at the beginning in the financial service, people who are writing about the financial community or making predictions or making recommendations about future trades or opportunities to trade, but it could move into any area of expertise, which could be technology, it could be business. If somebody has that name recognition, what we would ask of them is that they publish first on the QBeats platform, that they keep their information reserved with us for a period of time, which could be 12 hours, 6 hours, half an hour, before it is released onto the internet, at which point the price would be free. So that's it from me. We are hoping to launch in the next 2 or 3 months. I'd like to encourage you all to download our application, which will be free and which will give you access to all of the news on the QBeats platform. And at least if you're not purchasing stories, see the dynamic, how the price of stories and content is rising. We like to think that we are on the edge of a whole new age in the pricing of content. Thank you very much.
Thank you. So, thank you all. I'd like to ask you guys a few questions, then we'll open it up for questions. One of the themes that really interests me here is how the intersection of the technology that was delivered actually changed the industries that we're talking about. And, you know, Peter, in your examples, those changes I think are apparent. Mark, in your shift to real time, that change is not yet apparent, but looks like you're on the cusp of it. And Adrian, we already know about how real-time news, high subscription fee real-time news changes things. So I'm interested to hear you talk about how you think they may, things either have or will change the industry, because I think there are parallels for people here as they think about introducing new technologies and moving to real-time, to the kind of disruption that might happen in more traditional information industries.
So we see it every day. See it every day, and it's picking up pace every day. Our customers are engaging in developing and back testing investment strategies for their clients and for their own books. We're seeing out of the corporate community, the treasury function become increasingly sophisticated and engaged, and in some cases actual market-making participants in the markets. And it's happening because of the technology, because of the availability of the services. So, I think, it's not just a question of the number of trades going up at smaller pieces. There are actually new participants in new lines of business. I can't think of an investment management firm who hasn't changed their business in the last 10 years. And I think that we're just going to see more and more of that going forward.
I would agree, and for all the same reasons. One of my last jobs when I was in Reuters until quite recently was I was the journalist responsible for overseeing the arms race that Peter described in our timings against Bloomberg. And we always described it in those terms. There was an arms race, and it required huge investments. And the debate among the journalists is, should we be putting that money into writing stories that are breaking new ground, that are telling our customers something that's really new and different and being contrarian and opening their eyes to new possibilities? Or should we be investing in this really dull, technologically driven arms race? And predictably, we were just putting an awful lot of money there. I guess the thing that one has to highlight is, as you did in your graph, which was very illustrative, it is a race to zero, because at some point there will be no difference in time between the two. I think, sadly, the Treasury Department is only waking up to this right now in the last few weeks, but this has been happening for at least the last decade or so.
Well, there's some interesting examples. There was a recent example of the people starting to write about the release of economic news, the embargoes, and then how various agencies basically have the information all teed up, and it's out in fractions of a millisecond, and the people going to file stories are, it's already happened. The news is out, and I saw that the government is now thinking about releasing their information in real time, and you could see a point at which the government might release sub-statistics or other information at the point they had it, and just kind of put it out there, and everybody has access to it and can run their own models and do things like that. So we might see that kind of shift. Well, when you think about the other information, the rest of the information industry, one of the things I'm particularly interested in is the Internet of Things, which was mentioned this morning. That represents huge volumes of time series data, may represent huge opportunities for people in this room, but presumably has a lot of parallels with with what we've seen happen in financial services, time series data. Do you want to comment a little, Peter, maybe on some of the technologies in that space and what you see happening, where you see them being adopted outside of financial?
Sure, yeah. I mean, we have people starting to reach out to us to get involved in the kinds of technology research we do from completely different industries. So smart grid is a good one, for example. So this is the sort of the revolution that's slowly taking over the utility industry, where there's bidirectional flows of power. People can have a solar panel in their house and send power back to the power station and so on. And a lot of things have to happen very quickly, and there's a lot of databasing that goes on. And so this data, that's just one example, but there are a lot of examples where these time series have to get processed very quickly, and there are a lot of specialty systems, some of them from the big name vendors, but a lot of them from smaller vendors that are specifically optimized for that kind of thing. Hospital ICUs are another example where they're starting to bring in technology that are pulling in streams of data from all the different sensors, all the vitals and all this other sort of stuff, and applying sophisticated algorithms to try and predict, is this patient gonna code on me, that kind of thing. So it's probably going to happen all over the place.
So, I mean, time series analysis in the capital markets is bread and butter. I mean, there are probably more people running around Wall Street running regression lines through time series and finding, trying to predict tomorrow's closing price than anywhere else in the world. The technologies are there. I mean, I think the move is very clearly out there to things like columnar database technology, graph database technology, in-memory computing. The technologies are there. The costs are nowhere near what they used to be in a mainframe world. And I think most important thing that comes out of it is that ability to perform that empirical, statistically driven analysis is now built into whatever front end you're using from your bank to look at your 401k. It's there, it's pervasive, you're leveraging these tools, and at the end of the day, that's a good thing, because now you've got a much more statistical view on the risk you're exposed to and where you're going. But I would say those technologies are there, and we're just going to see more and more of them. They're coming at you.
Let me take any questions from the audience. Do we have any questions from the audience?
While we wait for that, just one follow-up point to that. I think if there's anybody in the audience, wondering how to go about looking for some of these opportunities, I would say don't worry about the technology, because as Mark says,
Completely agree.
It's there. Don't assume that something can't be done. I mean, the banks today, for example, in managing their risk, they have to take in massive amounts of data, run millions of simulations. What happens if this happens, that happens, and this is kind of stuff that used to happen overnight. They're able to do that in real time now, and the only reason they didn't do it in real time before was because the computing power wasn't there. It's there now. I mean, there's almost nothing you can't do. So look for the opportunity.
We have a question?
Yeah, this is for the qubits guy. I'm sorry, I forgot his name.
Adrian.
Yeah. What, in terms of the pay-per-view model, I can imagine it working for more mass media or larger publishers, but for very niche publishers on the long tail, I mean, wouldn't they be already hitting their market and looking for a new, rather than looking for a new content distribution, wouldn't most of the market actually be, they'd be already saturating that marketplace?
So, I mean, that's a really good question. I think that's something that we're going to have to experiment with. But let me, without naming names, let me give you the example of a conversation I had with a young lady who I met today. And her company produces technical analytics on energy market. They do really well in the United States. They're very successful. They've got a great brand name, and they distribute over I think they distribute over Bloomberg. 1, 2, they're interested in reaching a more global market. They think there are opportunities in the Middle East, in Asia, in Latin America. But the fact that they distribute over Bloomberg, and you can imagine at Bloomberg you're paying $25,000 a year just to have the terminal. And if in addition to that you also have to carry these niche information services which can run up to $10,000 a year, that's a substantial price tag. So distributing some of their information over us is a really big advantage. 1, because we do carry the subscriptions if they want to carry the subscriptions, but we can also sell individual stories, and we can sell subscriptions for 6 months, 3 months, 1 month, and give a customer in India who would not be willing to pay for a Bloomberg terminal the opportunity to access their information, something that they wouldn't be able to do right now.
So I think we're out of time, but I would say, by way of summary, the hope that we had in putting this session together was that you'd walk away with a recognition or an idea about how in your sector of the market, by moving to real time, by moving to lower latency, you may find incredible opportunities. Some of them may come by selling information into financial services, but the experience of the companies who have made that leap and who have pushed the technology barriers, they've been the net winners in this market. And these technology-driven changes will happen whether the traditional publishers take them or not. And so our hope was to give you some illustrations where we've already seen how the movie plays out. So I want to thank the panel, Peter, Mark, and Adrian, and thank you all for your attention.